Now, as we said earlier, where you had existing home sales coming down, if you remember, we had said that they had fallen 3.4% versus the estimate of 3.7%. So, but still moving in the wrong direction and starting to see that negative movement. But it's important, to think about this holistically. So the construction cycle has also peaked. So when you think about expect completions to keep rising as those backlogs clear and that lagged rollover in units under construction. So as the supply chain progress is definitely unlocking some of that supply of new rentals and purchased units. So you're going to see some of that come back. So even though we still remain fairly low on available housing, the shift is real. So when you look at housing units going under construction, this just looks back to May of 2006. You can see that we are well above where we were prior to the housing collapse of 2008. And then when you look at the annual rate of housing unit permits are still slowing. But again, why would you build so much when you still have so much backlog? And this will help kind of counter and start to balance out and normalize some of that piece. Now, the house price to rent ratio is the highest since 1980. When you look at, typically when you're at these levels, it really creates a recession. It doesn't really mean you're in one. It puts you into one when you look at some of the price to rent ratios, which, as you can see, is the highest it's been since the 1980s. And it puts more pressure on, again, the consumer, especially when you're looking at that sticky cohort of inflationary pressure, which is a huge part of it. 42 to 47%, depending on which metric you're using, is made up of housing on the CPI. So as these prices remain at these crazy levels, that's why we see sticky and core inflation as a pervasive problem, even as some of the flexible side and flexible drivers start to come off from their all-time highs. But again, when you start looking at the positioning and how people are seeing this, they're talking about it, they're reading it, they're joking about it on Twitter with memes and GIFs and whatnot. But total equity fund flows still remain at all-time highs, even as the S&P has rolled over. As we showed in the previous segment, the sentiment and the positioning do not match. So despite the large market correction, flows into equity funds, ETFs, and mutual funds have been robust, with a cumulative $210 billion year to date, or 1.2% of AUM have been added, even as, and again, coming back to that averaging down, just continuing to pile into the market. All the while, here's a very key leading indicator that we love to look at. The outlook for unfilled order components within the June Philly Fed fell deeper into contractionary territory, now at its worst since January of 1979. Again, all of these things are the unfilled orders, new export orders, all of that, and backlog. All of that is showing what is to come, and you're seeing it come well below where we've been in previous downturns, and not something we've seen since the 70s. So then when you start looking at, again, manufacturing unfilled orders, now negative, expected unfilled orders, as we just showed, deeply negative, again, all leading to current and future slowdowns on the order front. Then when you start looking at business outlook, so the divergence in inventory components with the Philly Fed, which is the blue, has come down, but the New York Fed, which is the orange, has gone up. So the former slipped into, so Philly has flipped into contractionary territory, while the while the New York or Empire bounced a bit higher. So again, there's still some of this divergence, which is why we do have some of that growth in Q2, but the leading indicators are the key ones, or the ones that tend to be the most closely associated with growth or a slowdown, continue to move in the wrong direction. So the Philly Fed manufacturing prices paid still remains elevated, obviously off the highs, but still very elevated. And then when you look at the Philly Fed and ISM manufacturing, so this is ISM manufacturing on the national level, you can see how tightly correlated they are in terms of trend, which is why as the Philly Fed, as you can see in the red, is in contraction, that is going to pull down the national level. Philly Fed manufacturing fell 6 points to negative 3.3 in June, the lowest reading since May of 2020. Slower manufacturing growth shouldn't be a surprise as services lead growth, but the pace at which the data are turning negative or contractionary is obviously concerning, as we've been highlighting. And then on a national level, another bigger issue is the U.S. manufacturing production continued to move down. It is now slightly contractionary, expected to be at 0.3%, came in at negative 0.1%. And the manufacturing capacity just started to turn. The utilization is going to be key. How much does that turn? How much does that roll over? Where when you look at manufacturing production, that's usually kind of the leading indicator. So we do expect to see this again moving in the wrong direction, moving down, especially when you start looking at some of the inventories. Inventories are at all-time highs in some cohorts of the economy, which again is going to keep this fairly pinned to the downside. Philadelphia new orders steeply negative. Expected new orders also steeply negative. So that's, again, those leading indicators that we continue to talk about that are showing where the problems are arising. Now, when we start turning back into housing, May housing starts came in at negative 14.4% versus the estimate of negative 1.8%. Building permits came in at negative 7% versus the estimate of negative 2.5%. And again, if you have such a gigantic backlog, there's no point in starting a new home and getting a new permit. Just focus on what you can clear. And at the same time, can you get the borrowing that you need to start this home? Or is the bank essentially saying, look, sell what you have. We're not financing the next start. So again, you're starting to see those pressure points continue. Now, housing inventory estimates. So this is total housing units in the United States. Spiking mortgage rates, more homes to population than any time in history, most homes under construction since the 1970s, a falling working age demographic, as we discussed in segment 1, higher speculation now than ever before since the great financial crisis. This is why we don't think there is an inventory problem when you're looking at it holistically, especially as these new completions, these new homes are completed. And all the while, mortgage rates, the 30-year, with the Freddie Mac U.S. mortgage rate survey, 30-year, year-on-year change. So it is the highest change since the 70s as it's coming, or I should say since 1980, coming in at 3%. New home inventories are pointing to more price declines as new home supplies have shot up and then home prices have come down. And a lot of that is driven, again, by the massive surge in rates. Now, some of the key important pieces of this when we start looking at manufacturing, at production, is housing and business investment is rolling over. So as that continues to roll over, that's a negative driver for GDP. We've talked about the consumer, how they're going to struggle, but now you're seeing, again, the I in GDP, because GDP equals C, the consumer, plus I, investment, plus G, government spending, plus X minus M, which is, again, exports minus imports. So when you look at this, you're seeing, again, this big downdraft with housing and business investment in the U.S. tumbling as the economy continues to weaken in an all but inevitable recession. Housing represents 15 to 18% of GDP, which is a meaningful metric to watch, with existing home sales numbers falling again into negative territory. You're seeing, again, that downdraft when we're looking at the economic backdrop. So then when you start looking at the conference board and the leading indicators, the leading indicator is negative. It's not as steeply negative as other things. It's moving in the same general direction, but one is holding up much better than the other. And it's, again, this is why you look at multiple data points, because you want to get the trend. Is the trend moving? Some will show extremes, others will show a bit more of a bullish sentiment, but they're both negative. They're both moving in the wrong direction, which again leads to, even if you have this one, which is obviously much better than other indicators, you're still in a negative trajectory. And then when you look at the leading indicators, that dipped by 0.04 in May and has now contracted for 3 consecutive months, which hasn't happened since the COVID recession. So again, it's not so much the depth in which this goes when you're talking about the conference board numbers, it's how long are you in contraction, because you don't really get these huge washouts as we do in the University of Michigan data. Instead, you kind of get are we hanging positive or negative? And here you have that negative trend continuing. So then when you look at, again, the industrial production in May came in at 0.2% versus the estimate of 0.4%. Manufacturing activity fell negative 0.1 versus the estimate of positive 0.3. And that, again, you're seeing that down move on a lot of different pieces driven by housing, driven by business investment. Now, when we start looking at some of the leading indicators, we have a move back down for restaurant retail sales on a 3-month average basis, which breaks up trends that established heading into summer. And if you think about it, normally we get an increase in summer when you think about people going out to eat, you want to sit outside, you're going to go on vacation, you're going to eat out more, but you're seeing it actually kind of bulk against what is normal, and you're actually seeing that drop. And again, this is more of a leading indicator for some of the pressure when you look at pricing and the consumer. So then when you look at the National Association of Home Builder Traffic Prospective Buyers, so prospective buyer traffic component of June for the builder confidence update fell to 48, its lowest since June of 2020. The housing market continues to show signs of struggle under the weight of depleting affordability. Supply chain stress is easing. Outlook for prices paid and delivery times edged a bit lower. But when you look at it coming down closer to its lowest since the pandemic started, but you're still kind of holding in here. And that's what we've been saying, is that we get more of a sideways move and less about a big correction down, but instead kind of holding at these highs based on these different metrics that we've been following. Existing home prices, when you look at the South, it's been holding fairly firm while the national average is down. A lot of that is being driven based on the West as well as the Northeast, which has never really come back in the Midwest. And then when you look at the surge in home buyer mortgage payments is now at over $2,500. And you can see how there's been a surge from just under $1,700 to now just over $2,500 in a very short period of time, which is why 6% of listings had price drops over. This is the 4-week rolling average. You can see that we're starting to see that big increase. And then the home buyer demand index is moving in the wrong direction. So you're starting to see price drops as you're seeing that home buyer demand index drop, and we expect them to continue to move in opposite directions as they try to bring home buyer demand back. But as the affordability of buying a home goes down, the rent index year on year remains over 14% because people are stuck in their rentals. They have no choice, so they just re-up. Single family attached versus detached rental growth, you can see that it is still close to anywhere between 13.5 and 14.5%, depending on the metrics, which again is going to keep sticky core inflation elevated and continuing to trend up, because if you remember from, I think it was 2 weeks ago, we talked about how core CPI and the housing component is only showing 4.5%. But every metric that we have shown you is anywhere between 13.5% and higher. So again, there's still that trend up, which is why we're going to continue to see core CPI and core, the sticky inflation driving higher. Single family rents soar. Miami's rental prices surged almost 41%. So the surge in rents continue. U.S. single family rents jumped 14% year on year in April, marking the 13th period of record-breaking annual gains. And then when you start looking at growth in median price of existing homes for sale is rolling over, but it's still at 14.8%. So the rate is still very high to history and near peak growth rate seen in the run-up to the bursting of the subprime bubble, the 06 crisis, which again, we think is a very likely backdrop in terms of where we're heading. So realtors who expect a year-over-year increase in next 3 months of buyer traffic and seller traffic. So they expect buyer traffic to come down and seller traffic to go up. So again, you're starting to see year on year, I apologize. They're expecting buyer traffic to fall more than seller traffic. So again, putting more houses on the market, which will adjust the monthly supply, because there'll be less buyers, still less sellers, but more than there will be buyers. If you look at the blue and yellow, you're getting that huge flip as buyers don't come in. So what a difference a year makes. Redfin data indicates a significant drop in expectations for both buyers and seller real estate traffic in the next 3 months. And remember, we're in the summer. This is key housing buying periods. And they're not going to be there, with monthly supply for existing homes, improving. But based on the spread, we expect that to continue to get better. More price drops than any time since at least 2015. House price drops are picking up speed. On a rolling 4-week basis, the share of listed homes for sale with cuts to price is currently higher than at any time since at least 2015, as that continues to increase. And this is just picking 20 regional housing markets that were the hottest during the pandemic, if you will, and you get an idea of just how much things have changed in that short period, which is why when you start looking at the percentage of properties with recent price reductions is now above where we were in 2021, and we think it'll continue to close that gap because the rate of change is going to accelerate and really run headlong into where we were in, I think, at least 2018. And then when you look at existing home sales, down negative 3.4%, new post-pandemic low, down 17% from January. The Midwest, West, and South saw the biggest declines. Median price, again, 15%, $408,000. And then when you look at housing affordability, it's the lowest since 2007. As you can see, that big drop where as affordability comes down, that's going to drag down those home sales as well. And it's important to put into perspective where monthly mortgage payment based on the median existing home price, and that's where you continue to see that drive higher. Depending on the metrics that you use, it's anywhere between $1,850 to, again, that $2,200. So now when you look at the seasonally adjusted home sales, down 10%. So we're seeing a violent turn that defies seasonality. Home prices rose 1.5% month on month in May, their smallest increase of any May on record, which go back to 2012. Seasonally adjusted home sales fell 3% month on month. Because remember, May, which is the end of March to about September is like prime, and probably August is prime home sale periods. And we're just not seeing that kind of activity, which is shaking off the seasonal drop. And then the average mortgage payment, as you're, again, looking at the different pieces, you're seeing those increases in general. So again, as the consumer weakens, as their ability to access debt, as their credit cards, payments go up, all of these life-changing issues are going to continue to drive down the housing market, which, as we said, makes up a very large part of GDP. Consumer coming down, businesses slowing, government transfers not coming down. Again, you're going to see a lot of these pressures showing up, which is why we're so concerned about GDP in Q3. So that's what we have for you on the U.S. In the next segment, we're going to go deeper into Europe and what is happening there following the ECB conversation about fragmentation.